wonderful. Let's continue with our talks on money matters. And like I said, Diwali is coming up. It's time to not only clean your wardrobe and your homes, but also your financial portfolio. By that, we mean weeding out all those underperformers and ensuring that your portfolio still is adequately, does have all the adequate instruments and ingredients to help you achieve your financial goals, be it wealth creation, be it your child's education, saving for retirement, whatever be it, or even for that matter, buying yourself a swanky new set of wheels. Whatever your goal is, it's important that your portfolio as well meets those aspirations. So to help you do that, we have with us Harsh Roongta, the personal finance expert. Mr. Roongta, it's always a pleasure having you with us on The Money Show. We often do say that investing in mutual funds is obviously done for the long haul. One should not invest in mutual funds if one does not have a long-term time horizon of at least more than 5, 6 or 7 years. But that often leads to complacency in the sense that somebody just buys mutual funds, keeps them away, and then does not look at them at all. How important is it to keep giving your portfolio a review, giving it a check? Because there have been instances in the last 1 year where we have seen debt mutual fund values being thrashed out of shape completely.
So I think what you are saying is that what is more important probably than even the choice of the scheme is the category. So I mean your asset allocation, which means how much to debt and how much to equity, and that long-term bit about 8 to 10 years applies more to equity than to debt. You could have fairly short-term investments in debt mutual funds. Uh, so, I mean, I think you could use any occasion. Diwali is a great occasion when you do a spring cleaning. The spring cleaning need not be restricted to your physical environment. It can be your financial environment. It can be your spiritual environment, whatever it is that works for you. And one of the things that you could clearly do is to realign or do a reallocation of your assets depending on what's happened to your goals. Have some goals come nearer? Should you start tapering off? Because of market performance, your asset allocation might have gone below or above whatever it is that you wanted to do. And Diwali is a good time. I mean, whatever occasion works for you, that's a good time to do the reallocation. And within that reallocation, if you have had a scheme that hasn't worked well, you might look to replace it with a scheme from the same category. This one of these things you mentioned that we should keep on doing this. There is a concept, and especially now, and especially say to the extent your allocation is to large cap. One of the things that you could sort of fill it, shut it, forget it, is a index fund. I mean, you buy a Nifty 50, Nifty Next 50 kind of a fund, or now you even have a Nifty 500 fund available. That's a multi-cap, a large mid-cap, small-cap kind of a fund available. You're buying the market essentially. That's a fill it, shut it, forget it kind of a investment, as long as it fits in within your asset allocation. So I think it's not a bad idea not to be too active on changing one scheme for the other, especially in equity mutual funds. In debt, I would agree with you that you need to keep an eye out and be slightly more nimbler in terms of shifting from somewhere where a problem is occurring. And I think that's where a good advisor or an investment advisor would play a role.
Okay, so within equity mutual funds, don't shuffle around too much, but it is in debt mutual funds where you do need to be cautious of any sort of alarm bells that may ring. So Harsh, what are those alarm bells then? I mean, when is it that an investor should go to a financial advisor or should consider that, okay, hey, look, this fund is detrimental to my portfolio, and obviously I'm saying debt mutual fund, but yes, at what point should this investor then believe that, okay, now there's a problem in my portfolio?
So I think even in debt, if you have done it under advice, you would typically have chosen a fund that matches what your goal was. So if you had a 3 year or a 2 year goal, you would have chosen a debt fund that had that sort of a time horizon, etc. Where you can probably go wrong is on credit. I mean, typically if you've taken an aggressive call on doing funds with a lot of credit risk involved in them in the hope of getting a higher return, uh, right now is not the time for doing that, especially if your goal is nearing. I mean, you would probably be in a debt fund in most cases, because your goal is not very far off. It's in the next 2 3 years or so. In that case, I think doing a credit risk fund might not really be a good idea, especially in the current environment. So you might look to change that. Uh, Interest rate risk, on the other hand, in terms of, say, going in for funds that have the long tenure debt in it, whether it is government securities or even corporate bond, again, that is a fairly active call, which I think either you have to be an expert or you need to take expert advice. But for a lay investor, I would say that the worry would be on credit risk, and that is something I think you need to watch out for.
Right. And Harsh, you mentioned allocation as well in your first answer. And of course, it would be ideal if an investor, when creating their portfolio itself in the first place, ensures that they put in the high wealth generators with the help of financial experts like yourself. So, what is the ideal asset allocation between debt, equity, and especially if an investor is young? Let's say he or she has just started off his or her job and has got that regular flow of income starting to come in. What would be the ideal asset allocation then?
See, the thing about asset allocation is that there is no ideal asset allocation because it depends on a lot of things. It depends on what kind of tenure. So, for the same person, when he is looking to invest for something that he wants the money for, say a car you want it in 2 years, obviously, even though your risk taking ability might be large, you might want to invest only in debt or maybe a bit of a equity saving kind of a fund if it's happening in 2 3 years. For the same young person, when he is looking to invest for his retirement, which is still a long time away, and he is by nature a risk taker, he could look at a pure 100% equity kind of an investment. So I would say that there is no ideal asset allocation. It would typically depend on when you need the money, what is your risk taking ability, and how much resources you have vis-a-vis and you will have in the future vis-a-vis what you need. I think it's a metrics which will determine an asset allocation for a specific individual.
All right. Okay. So that's, of course, I think you could say not exactly a golden rule that one must follow when there is asset allocation. It also, of course, depends from person to person. But yeah, it's very important that you ensure you look at your own profile, your financial profile, your risk taking ability as well, and then accordingly take the decision.